My parents transferred a whole life insurance policy to me when I was in medical school. Once I got married, I'm now 35, married, one kid, fresh out of fellowship, working, doing urgent care. I transferred the whole life insurance policy into a variable universal life policy after doing some reading. I'm not sure if that was the correct action. That's what I did. The death benefit is $100,000, and currently the net cash value is $6,693.29. Annual premium is $300. I would like to get rid of this as I feel like I have better use for that money, but I was hoping to get your thoughts. Thank you so much for what you do.
Okay, Tyler. Good question. Sorry, I thought you were a medical student. I guess you got the policy given to you as a medical student. Lots of parents do this. They think they're doing you a favor by giving you a whole life insurance policy. And I don't know who's selling it to them, whether it's Northwestern Mutual or Gerber or who it is. But they suckered your parents into buying this thing for you. And your parents did it with the very best of intentions for you. So I think the most important thing to do here is to recognize that they are doing this with a lot of love and sacrifice in a lot of cases, because many of our parents are not all that well off, sacrifice to try to give you a leg up in life. And so the most important thing in this whole discussion around these gifts of whole life insurance is to say thank you, to thank them for what they've given you. It's really a very nice gift. In essence, they've given you $6,000 or $7,000. That's what's happened here. You can do whatever you want with that $6,000 or $7,000, though. You do not have to keep it in a whole life policy. They will not be upset. You do not even have to tell them that you cashed out of the whole life policy. You could exchange it to some other insurance product, a variable annuity, a variable universal life insurance policy, a long-term care policy. You can exchange it into all kinds of other policies. But the truth is, you probably don't need any of that stuff. And we're talking about a very small policy. I mean, your cash value is only $6,000 or $7,000 here, right? There's no sense in messing around with these exchanges into a variable annuity to try to, save the basis and get a little bit of tax-free growth out of that. There's no point. This is $6,000 or $7,000. So make sure you've got your big fat term life insurance policy in place, right? You're a brand new attending. You've got a spouse. You didn't mention what your spouse does, but you've got a kid. You got people dependent on your income. If you die, it's a financial catastrophe for them. So you need a big, fat life insurance policy, not $100,000. Okay, they'll burn through that pretty quick if you died. You need a term life policy. Okay, something that's going to last for the next 20 or 30 years until you're financially independent. That's going to pay them a seven-figure amount if you die. $1 million is kind of the bare minimum for an attending physician that has other people depending on him or her. Most white coat investors have probably got $2, $3, maybe even $5 million in term life insurance. So the first thing you need to do is make sure you have that in place, whatever your amount is. And how much you need depends on, what your spouse is going to do if you got disabled or if you died rather. And maybe some people need less than others, depending on what you have or what your spouse does or what your lifestyle's like. But get that big policy in place first. And then what you do is you simply surrender this rinky-dink little VUL that some dirtbag sold to you after some other dirtbag sold your parents a whole life insurance policy. And you walk away with your $6,000 or $7,000, and you use it to pay off your student loans, or you use it for a down payment on your dream house, or you use it to pay off your car, or your credit cards, or you use it for your backdoor Roth IRA this year, or your spouse's backdoor Roth IRA, or you don't technically put that money in there, but you live on that money while you use the money you were living on to go in there, because it has to be earned income, of course, that goes into a retirement account. But my point is, you have a better use for this money than a VUL as an attending straight out of fellowship. The chances that this is the best use for your money is essentially 0%. There's no way this is the best use for your money right now in your life. So take it out of there and use it for something else. If nothing else, you can put it in a 529 for that kid. Because the truth is, what your parents should have done, if you can go back 20 or 30 or 35 years, whenever they bought this thing, what they should have done is put this money in a UGMA account or a 529 or something where it would have grown. Because if you go back and actually figure out what your rate of return was on this policy, it's going to be embarrassing. It might even still be negative after 20 or 30 or 35 years, because these little tiny policies, all the premium gets eaten up by the fees. And so they tend to have these terrible, terrible returns on these tiny little policies sold to parents. But yeah, you don't want to keep this thing. You need to get rid of it. So get rid of it and use the money for something else. No big deal. Just make sure you have term life insurance in place first.
The hosts of The White Coat Investor are not licensed accountants, attorneys, or financial advisors. This podcast is for your entertainment and information only. It should not be considered professional or personalized financial advice. You should consult the appropriate professional for specific advice relating to your situation.